Good day. This PowerPoint slide deals with bank reconciliation. Cash can be stolen as it's easily concealable, and also fraud can be committed with cash. This can be prevented by having more cameras installed, having better internal control, meaning your internal auditing process should also be up to scratch, but also when there are the division of duties can also help to prevent that something goes wrong with regards to cash. When we are going to look at the reconciliation of the bank, it basically means that we are dealing with two systems. Firstly, transactions will happen with the bank, and the bank also keeps record of what is happening with our money in the bank. Therefore, they will also send us a bank statement to show what transactions they have recorded with regards to cash that was deposited and cash that was paid out of the bank account. We also have our own records in our own entity. Therefore, those cash receipts and cash payments will be summarized in our bank account according to the general ledger. It can happen that transactions are not recorded by both parties, the bank and our entity. Certain transactions can happen only at the bank, and certain transactions will only happen at our entity, and therefore sometimes it happens that not all the transactions were recorded by both parties. We need to remember that when we have a debit entry into our bank account in our books according to the general ledger, we will debit bank, for example, when a capital contribution is made by the owner, when there are cash deposited into our account, meaning our assets will increase on the debit side. But according to the bank, that will be a credit entry in their books. So the bank statement will typically record this on the credit side of the bank statement. Why on the credit side? Because we are a liability to the bank. They owe us our money. When we decrease our asset on the credit side, so if bank is credited in our books, then the bank will have a debit entry in their books. As cash is paid out, our entity, our books in the general ledger, our bank account will basically say we credit the bank as our asset gets less because money was paid out, but the bank says, oh, the liability decrease, therefore the bank is debited in their books. Our account is debited in their books. Because we're dealing with two systems, our books and then the bank's books, we need to bring these two sets of books together to show the same transactions in the end by doing a reconciliation. The reconciliation process is firstly that we need to update our books, the entity's books. So any transactions appearing on the bank statement but not in our books, those transactions need to be recorded. It will be recorded in the general journal in a combined general journal entry. All transactions will affect our bank, therefore the net effect on the bank, that will be posted to our bank account in the general ledger. This is an example of a combined general journal entry where all the transactions affected the bank. The bank is basically then the net effect, the 1,550 Rand. That is basically the balancing figure in the end to let the debit and the credit side add up to the same total. That net effect must then be posted to the bank account in the general ledger. In the general ledger, we will start off with the opening balance, the total receipts, the total payments, and then we also need to remember, hey, put in that adjustment, that net effect, which you have just recorded in the general journal. And then determine the closing balance of your bank account. Secondly, after we have updated our books, Then we are going to basically update the bank records, but we are not going to redo the whole bank statement for the bank. We are going to basically extend the bank statement by recording the transactions that the bank did not yet record, and we are going to do that on behalf of the bank. Any transaction that we record on behalf of the bank is recorded in the bank reconciliation statement. This is a typical example of your bank reconciliation statement. Here where we record transactions on behalf of the bank, we will start off firstly with where did the bank statement close or ended up with. So the closing balance on the bank statement will be our point of departure. We will record any outstanding payments and any outstanding deposits. And then in the end, our debit and our credit column should have the same total. Remember that the balancing figure then should represent the closing balance as per the bank account in your general ledger. Therefore, look the last entry there, debit balance according to the bank account. That is basically then the balancing figure not only for the bank reconciliation process in your bank's reconciliation statement, but it should be the same amount and on the same side as what is appearing in your bank account in your general ledger. Thank you.